Welcome to another episode of Equity Mates, another week here in the AusBiz studio. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Great to be back for another week, an exciting week, a week jam-packed, full of experts. But we're starting with our best foot forward with one of our favourite returning experts. Owen Rask is joining the show.
That's it. It is our pleasure to welcome Owen back, CEO and founder of Rask Invest. Owen, welcome.
Thanks, gents. Always a pleasure.
So, Owen, we've loved having you on Equity Mates on AusBiz over this year. You've always provided us with great insight into companies that you're watching. And so today we wanted to bring you back on to go through three that are on your watch list at the moment as we count down towards the end of the Equity Mates year here on AusBiz. So let's start with the first one, which is SiteMinder, a stock that has recently IPO'd. Its ticker is SDR. So what is SiteMinder and why is it on your watch list?
Yeah, sure. Thanks, Bryce. So obviously the business is a recent IPO, which makes it interesting because it's not every day you get a $100 million revenue software business that hits the ASX. And so what does it do? SiteMinder effectively connects hotel owners to the internet and to bookings. So if you have a small hotel, a motel, you can effectively put up your rooms to let, and you can do that all in one platform. And it basically takes care of everything. The bread and butter of SiteMinder is something called Channel Manager, which effectively allows you to upload your inventory, if you're a hotel owner, directly to different portals all in one go. So it's a really, really easy to use platform, and it's grown pretty quick since it was founded in 2006.
Yeah, it is a fascinating story, and it's great to see Aussie tech companies staying in Australia and listing in Australia. But the hotel industry has gone through a pretty challenging 18 months, and even longer term, we've seen the rise of disruptors like Airbnb. Why is it that the hotel industry, why is that an industry that you're particularly interested in, Owen?
Yeah, so the travel industry globally is a huge opportunity for any business. I think the key is here not to get bogged down in kind of who is going to disrupt something like SiteMinder, because SiteMinder's been around for a very long time, and it's been around since basically before everyone was using Airbnb. The key things to watch with SiteMinder is obviously how many sites it can grow, but also its margins. It's a really impressive business that's been kind of hidden behind COVID. So the IPO, depending on which way you look at it, could either be the perfect timing for investors looking to buy, or it could be the worst timing for a seller. And I think the fact that the shares popped on IPO tells you that most investors think that the best days ahead of SiteMinder. And so, we've got high margins or wide margins. We've got a business that should be able to scale. We've got, fresh on the ASX, so it should get a lot of attention, and should be able to build, a good track record around it PR wise. So we expect some growth ahead, and we think it's a business that's impressive from a quality standpoint.
Yeah, we've spoken to Paul Wilson from Bailador, who were investors in SiteMinder prior to the IPO, and they're certainly pretty bullish on the future of SiteMinder. But let's move to the next one, Owen. Australian Ethical, ASX ticker is AEF. Why is Aussie Ethical appearing on your watch list?
Well, you guys know as well as I do. I mean, you'll see this in the Equity Mates community. You see it everywhere. Everyone wants to learn more about ethical investing. Whether that's you just taking a sustainability perspective to your portfolio and you apply that lens and you think, okay, I'm going to exclude the sin stocks, or whether it's being much more tactile and being much more hands-on with things and looking at each company case by case. People that Australian Ethical basically serves all of those audiences. So depending on if you want to be really focused with your money outside of super, you can go to Australian Ethical, you can give them your money and they'll invest it for you. Alternatively, you can elect to have your super paid into Australian Ethical super products. And so the basic, underpinning of the business is that it started with superannuation, making superannuation really accessible for particularly the younger demographic who have this kind of ethical bent. And more we're seeing them push with the managed funds and get that marketing and roadshow happening. And so if you think about the product suite as a whole, what actually happens is inside a super product, most organizations don't make a lot of money from that, because even if you charge $50 or $100 a year plus a percentage fee for ongoing investment, the thing is, that's still a very competitive industry, and we've seen, the big industry super funds in that space offer ethically aware solutions or socially aware solutions. But the thing is, if Australian Ethical can be successful in the managed funds push, it can obviously charge a lot more because this is more discretionary dollars. So it's not necessarily something that you tuck away forever where you're really mindful of fees. This is a product, or these are products where you can invest your money knowing that you might pay a little bit more, but you're willing to do so because you're getting that active performance. So I'm interested to see where Australian Ethical goes over the next few years. And as we all know, funds management businesses are beautiful businesses at scale. The easiest way to get rich is use someone else's money to do it. And if you can find a fund manager that can invest for the long term successfully, there'll be performance fees and management fees coming in the door.
Easiest way to get rich is use someone else's money. That is Bryce Lesky's life motto. So good to see that it's rubbed off on you, Owen. I think you're right. Ethical investing, sustainable investing, it's been the biggest topic of 2021. Well, maybe the second biggest after crypto, but it's been up there in the Equity Mates community. But Australian Ethical aren't the only fund manager playing in this space. How do you think about the competitive set for Australian Ethical, and I guess the competition for our superannuation dollars and the big institutional allocations?
Yeah, that's a great point, Ren. So you and I both know about Future Super, Aware Super. There's many others in this space that are competing for these dollars. But I think the thing is, there's plenty of it to go around. The superannuation pie is growing rapidly throughout all of Australia. There's expected to be trillions of dollars in there, and I think over the next 20 to 30 years, that's what we're looking at with a business like this, positioning itself ethically in a growing sector. So if it can scratch out even a small percentage of that over time, I think investors should be handsomely rewarded, but keep in mind that the shares don't come cheap. So you should expect some volatility between now and then. Just look at the Australian share price chart again. You'll see that it can be pretty volatile depending on expectations of whether it delivers.
So Owen, let's move to the final stock, one that's just recently gone through a name change, and that is Facebook, now known as Meta. The NASDAQ ticker is FB. So why is Meta on your watch list?
Yeah, so it's a really interesting company, right? We all know it. We all know Facebook as the social media juggernaut, over 3 billion users, owns Instagram, owns WhatsApp, owns Oculus, which is it's a totally different business, which creates VR headsets. I actually had some friends over my place last night, and I have a set of these VR headsets. And the basic idea is that you put these goggles on and you cross over into a different, I guess, reality. And you can, like you're seeing on screen now, you can play with friends, you can catch up, you can say g'day, and you can create a whole new avatar for yourself. You can wear funky clothing like that. So you can transform basically who you are. And I'm not saying that that's the only reason that we would use something like this, but that is definitely kind of the space aginess of it all, the kind of out there thinking. But the thing is, Facebook is investing over $10 billion a year into this. It's one of the few companies in the world, I think, that is capable of doing this. But this is a decade long, if not multi-decade strategy for Facebook. And I think with this huge amount of spending, obviously there comes a lot of risk. $10 billion a year minimum is a lot of money to spend, and Mark Zuckerberg is very, focused on delivering on this vision of his. And I think from a long-term shareholder's perspective, like myself, I've owned the shares for quite a while now. It's exciting, but it's also pretty unwieldy, because this is an industry that they hope will come to more than 1 billion people across the globe over the next 10 years or so. And the idea is that everything can be monetized. But the reality is we don't know what the metaverse is going to look like, how companies like Facebook will position themselves, and so on and so forth. So we've got a lot of water to go under the bridge. I think the core valuation for Facebook has to be its advertising business. And the iOS 14.5 changes, I believe it was, effectively dampen those recent results. But it's still good to see, even though we say Facebook, is a massive thing, hashtag delete Facebook, we've seen all of this, users are still growing. And that's really impressive for a business at this scale. So you've got that call option over the long term with the Metaverse play, which would be really interesting.
So Owen, the Winklevoss twins raised a $400 million funding round with their crypto business Gemini to build a decentralized metaverse. So I think we're about to see Zuckerberg v Winklevoss round 2.
2.0.
So I'm pretty excited to see that. But I guess let me let me put the bear case of Facebook or Meta to you, and you tell me why it's wrong. So the core platform is losing users, especially younger users, at a rate of knots. Instagram is also seeing declining engagement from that core younger demographic as Snapchat and TikTok eat their lunch. The advertising business is declining. Apple has accelerated that decline. A few years ago, they decided they were going to be a shopping platform and an e-commerce platform. That didn't really work. So now they're going to be a Metaverse platform, which is this nebulous technology set that will come around in some point in the future. But like the core business is declining. Why? Obviously, I have strong feelings about Facebook, but why am I wrong?
Yeah, so probably the one other thing that you mentioned, you didn't mention in the bear case, would be that some people have pretty strong ethical stances towards it in terms of it being, a little bit out there in terms of some of the things that have happened in the past. I think the thing to note, though, is that year over year, going off the most recent results, the number of ads served to users grew, while also the price for those ads increased. And so advertisers are still seeing this demand pushed onto the Facebook ecosystem, regardless of what kind of headlines say about this business. And I think I think you're spot on, Ren, about the younger demographic. I think that is the core risk, but I don't necessarily think that this is going to be something that we see in the immediate future, because I think the way the ecosystem has shifted is if you ask a 15-year-old or even maybe even a 10-year-old, depending on what their parents say about it, where are they getting their kind of online engagement with friends? They're not going to say social media. They're probably not going to say TikTok. What they're going to say is Roblox, or they're going to say Minecraft, or they're going to say, maybe if they're a little bit older, Call of Duty, and playing games in a much more immersive experience. And so Facebook, like many other big tech companies, is vying for this slot. I don't necessarily think that the outcome is certain. Far from it. In fact, we even see companies like Netflix creating games now and offering that inside their app because they realize this immersive experience is for the next generation. And so, Facebook might be one of the plays that you have. And I think you did really well to point out the risk there, mate. Like, you want to be mindful that there is downside to this business, even though it is a juggernaut in social media.
So Owen, to close out, because we have run out of time, so thank you very much for coming on, but Ren and I have a bet going on in the office, and it is that Ren thinks that Facebook will never reach a $2 trillion valuation. I think it will reach one. I think it'll reach one within the next 10 years, 15 years, something like that.
Something like that.
Pretty healthy runway. Which side do you take? Which has a better probability?
Well, if the only option is that it reaches $2 billion or it doesn't, I would probably say $2 trillion. Sorry, I would probably say that it does. And at scale, that might seem like a massive thing, but these big numbers don't really scare me, where they scare some other investors, because all it needs to do from here is double its profit. And if you wanted to just take the metaverse out of it, it could probably do that if you were valuing it off just off earnings. So I'm going to go with you, Bryce. We'll see how it goes from here. Maybe if Ren's right, we can buy him a drink next time we see him.
We'll buy him a drink in the metaverse, that's for sure.
Owen, Bryce and I have a case on it, but I'm happy to adjust it that if I win, you guys will buy me a case in real life. If you win, I'll buy you a case in the metaverse.
Case in the metaverse is probably more beneficial than a case in real life. But Owen, thank you very much for your time. And again, thank you for your time throughout the year in sharing your insights and stock ideas and investment opportunities with the Equity Mates community. We've loved hearing from you, and you've been a great support for us as well. So appreciate it. And if we don't see you again, I know we won't see you again on AusBiz this year. So I'm hoping we can see you again sometime next year.
Yeah, thanks, fellas, and all the best. Merry Christmas.
Same to you.
Thanks, Owen.
And that brings us to the end of our episode today. Plenty of content coming up for the rest of the week, though. We've got Watchlist Wednesday on Wednesday, obviously, and a number of other guests joining us as well that I can't remember.
A week of expert interviews. So join us same time, same place tomorrow. But until then, have a good afternoon.